All new at 5, a hot housing market now seeing higher interest rates for buyers.
The Federal Reserve, of course, raising rates yesterday. So tonight, as part of our Priced Out series, Garrett Archer goes inside the numbers on what exactly that means for you.
When the Federal Reserve increases interest rates, what they are actually doing is raising the rate that banks charge to lend to each other overnight. The increase is inevitably passed on to you and directly impacts variable interest loans like credit cards and student loans. But even with the increase, rates are still historically low. This is the effective federal rate since 1950, and it was as high as 19% in the 1980s and has been dropping ever since. In fact, since 2001, the effective rate has been over 5% for just 13 months, and that happened just before the Great Recession. So how might a rate hike impact the Phoenix housing market? Well, I spoke with economist Luis Cordova, and he told me that due to market conditions, it should have a minimal effect.
It should help, slow down demand a bit, but to be honest, we have such an imbalance with low inventory that it's not going to do too much.
And Arizona real estate definitely has an inventory problem. We are at the lowest number of available houses in the past 10 years. Right now, there are 8,380 active listings in Arizona, but they are top heavy with an average listing price of $810,000. Meanwhile, over 9,000 homes sold at an average price of $578,000. Those two numbers, active listings and homes sold, they tell us what the monthly housing supply is. Experts say 6 months of supply is a balanced market. Our monthly supply has not been above 2 months in 10 years. So while an interest rate hike may eventually impact mortgage rates, the data shows that inventory in Arizona right now has a much bigger impact on the price and availability of real estate. This is a look inside the numbers. I'm Garrett Archer, ABC 15, Arizona.